So you're a new investor. You're getting your feet wet, and you start learning a few investment terms. You hear that earnings per share is very important, you get a little more sophisticated, and you learn about the price to earnings ratio. Maybe get a dab of beta, a pinch of enterprise value, and exposure to the Greeks. All of these are important and interesting statistics. But my own personal belief is that the number one metric with the most importance that a new investor gets the least exposure to has got to be book value per share. My own belief is that if more investors realize the power of this metric, they could significantly improve their investment performance by better evaluating a stock with significantly more confidence. And the most important sector that you can use book value per share most effectively are the utility sector and the industrial sector. These two sectors are highly capital intensive with significant capital used to build major plants and facilities. And with high amounts of capital, you can exploit the best feature of the metric. An army of accountants have already valued your company. They've measured, calculated, and assessed your company's value as its book value. If the company had to dissolve today, these accountants estimate you would receive the book value per share in cash. Book value measures an investor's equity and is the sum of all the assets a company has minus all the debts. Book value per share lets you know how much net assets per share you've purchased. This can then be compared to a stock's price per share. And what's so great about book value is that it is painstakingly counted, measured, and reported by the company's chief financial officer and that officer's brigade of accountants. And because of laws and regulations, accountants are required to follow accounting procedures and accurately price the book value of the company. So why is this value so important? Well, if a company has a ton of cash and property, its book value will be higher. In the extreme example, if a company has $10 in cash per share and is priced at $5 per share, you're effectively buying $10 for $5. And you might think, no, the stock market isn't dumb enough to offer such opportunities. Well, you really don't believe the effectiveness of fear. There have been many cases during market corrections where the price of major blue chip stocks fell below the actual book value of the company. And barring exceptions of some poorly managed companies, the price of these companies would bounce back up after market fears resided. In normal market conditions, the price of a stock will hover around its book value per share plus the future earnings it will receive, discounted by a hurdle rate, all of which we will discuss in another video. You can see this phenomenon in a price chart of the utility stock Southern Company. The price constantly corrected back to the book value per share plus discounted earnings repeatedly throughout the year. This comes even as investors try to use the utility as a hedge against a correcting market. The problem, I believe, is that new investors only get the story about earnings per share. And while yes, this is a major part of the evaluation process, for utilities and industrials, it's only half the story. When you have both book value and earnings taken into consideration, you suddenly have a clear picture of when you should accumulate shares of utility and when you should consider it overvalued. But now that I've raved about book value per share, it's time to share my warnings to you. As a new investor, think of yourself as a detective. Your goal is to sniff out the truth from a company's executive team, the news, and experts, and really try to get a picture of reality. Just knowing the truth of a company's position is a very lucrative skill. For book value per share, there are many pitfalls you need to uncover to be sure you're not falling into a trap. And to be honest, we could spend an hour going through different pitfalls, but the two you need to first watch out for as a new investor is goodwill and capital projects. Goodwill is an intangible asset that reflects the value of a company paid to acquire another company minus that other company's book value. Goodwill is what your company thinks the acquisition is worth. If the executive team was wrong about this investment, this goodwill will one day be stricken off the balance sheet. Keep an eye on goodwill whenever your company makes a major acquisition. Capital projects are another problem child on the balance sheet. Capital projects have cost overruns, timeline overruns, and scope changes. No project goes perfectly, but some capital projects, like Southern Company's Vogel plant, have had billions in cost overruns and years in delays. If something goes wrong and that plant cannot produce nuclear-powered electricity, the company's accountants will be forced to write down this asset. This will set in motion a collapse in book value per share, and ultimately the market will adjust down the stock price. But if you can be a detective and watch out for these kinds of issues, then book value per share gives you a really good sense of the value of a company. Pair that up with earnings and interest rates, and suddenly you can calculate intrinsic value. And once you have intrinsic value, you can open your eyes to see what stock prices really follow. If you want to learn more about how to calculate intrinsic value, read our article on how to calculate the intrinsic value of utilities, link in the description below. If you liked a video on how to calculate intrinsic value using BVPS, subscribe to our channel to get notifications when that video comes out. My name is Chasser Johnson, and I'm the co-founder of StockBossip.com. If you're tired of financial media giving you hype about investments, only for you to lose your investments during the last market correction, give StockBossip.com a try. We're pushing the limits of how financial media works. We don't trend by hype, we trend stock articles by performance. We don't just take into account returns, but each suggestion's volatility and analysis. Sign up at StockBossip.com and draft your own team of experts to get investment ideas without hype. Are you a great investor already? Then share your ideas today and help us build wealth at scale.